In this video we are going to talk about dividend stocks with a high yield. So before starting, please like this video and subscribe to this channel for future updates. Let's start. Number 10. ABVI Inc. It's difficult not to mention the aristocrats when talking about dividend stocks. ABVI is one of the most well-established dividend aristocrats investors should be enthusiastic about in 2021, having provided 49 consecutive years of dividend growth. Not only does the pharmaceutical firm's track record speak for itself, but its future prospects appear to be equally promising. ABVI's revenue climbed 59% year-over-year last year, which is outstanding for such a well-established corporation. More importantly, ABVI has a solid pipeline of upcoming medicine releases, which could keep the dividend growing for years to come. ABVI's business model is bigger, more diverse, and in a better position to raise its already attractive 4.48% dividend yield now that the Botox company Allergan has been acquired. Above all, ABVI is about as safe an income investment as you can get, which is great news for anyone nearing retirement. Number 9. Federal Realty Investment Trust. Federal Realty Investment Trust has become known as one of the industry's top and highest-paying REITs. FRT is a real estate investment trust, REIT, that owns, operates, and redevelops high-quality retail buildings in some of today's most exciting cities. Federal Realty's mission has grown into one of the shareholders over the course of its 60-year history. Shareholders receive access to continued gains by creating long-term, sustainable growth through retail properties. More importantly, FRT will gain from the economy's reopening across the country. With practically all states now open, FRT might have a record-breaking quarter. As a result, the dividend yield of 3.63% is considered exceptionally safe, with lots of possibility for growth. Number 8. Ryman Hospitality Properties, Inc. Ryman Hospitality Buildings, Inc. owns 5 irreplaceable convention center properties that are managed by Marriott International and operate under the Gaylord Hotels brand. Many of the company's major holdings, such as the Grand Ole Opry in Nashville, Tennessee, are one of a kind and attract people from all over the United States. Ryman Hotel, on the other hand, was heavily damaged by the pandemic as a REIT in the hospitality industry, specifically one focused on major conventions. As a result, it decided to stop paying out dividends in order to keep its financials in order and invest in itself. As the country was shut down, Ryman Hospitality expanded its portfolio by renovating several of its closed facilities to make them more appealing than they were before the outbreak. As a result, every one of the company's properties stands to benefit from the country's reopening as soon as possible. When business picks up, the company's dividend will follow suit. Number 7. Healthpeak Properties, Inc. Healthpeak is well positioned to benefit from the aging baby boomer demographic. As the population ages, more people will become reliant on assisted living and medical institutions. This is where Healthpeak comes in. According to Yahoo Finance, Healthpeak owns and develops high-quality real estate in the 3 private pay healthcare asset classes of life science, medical office, and senior housing, with the goal of providing stability during industry cycles. This REIT appears to be a good long-term investment, and its diversification across several sites also helps to reduce risk. If nothing else, Healthpeak's business model should ensure that dividends are protected for a long time, which is wonderful news for the 3.33% annual yield. Healthpeak's growth potential indicate that its dividend has room to expand for a long time. Number 6. STORE Capital Corporation. STORE Capital Corporation is a net lease real estate investment trust that is frequently compared to Realty Income Corporation, one of the most well-known REITs on the market. By focusing on the acquisition of net lease investment properties, both companies prioritize dividends for investors. STORE has a well-diversified portfolio that includes assets in more than 2,500 property sites across the United States, whereas Realty Income has accumulated more than 6,500 properties over the course of its 52-year operational history. Although the comparisons are valid, STORE is a superior value and has greater possibility for growth. Perhaps more importantly, STORE is well positioned to benefit from the forthcoming thesis reopening. STORE could burst out at any time with the news of more acquisitions, as real estate investment trusts have been restrained for far too long. STORE's dividend yield, which is currently around 3.95%, is already high enough to be included in many portfolios. The company's growth potential, on the other hand, has the ability to develop an already good dividend into a terrific one. Number 5. Enbridge Inc. Enbridge should not require an introduction as a dividend aristocrat. Enbridge has been at the vanguard of the oil and gas industry for years, and it continues to do so in each of its business segments: liquids pipelines, gas transmission and midstream, gas distribution and storage, renewable energy generation, and energy services. Nonetheless, because of the switch to green energy, the market has been harsh to Enbridge. Many investors are concerned about Enbridge's future, but this is unwarranted. The demand for oil and gas transportation isn't going away anytime soon. More importantly, the corporation has in place dependable, long-term contracts that will keep stockholders satisfied for years to come. Enbridge's 7.24% dividend yield looks wonderful and should continue to look excellent for years to come as one of the safer oil and gas equities to add to a portfolio. Number 4. Brookfield Renewable Partners. Brookfield Asset Management Inc. is a real estate, renewable energy, infrastructure, and private equity-focused alternative asset management firm. Brookfield Renewable Partners, on the other hand, is a subsidiary of Brookfield Asset Management, a firm that appears to be well-positioned to benefit from a greener future. Brookfield Renewable Partners, as its name suggests, owns and runs renewable energy infrastructure. Brookfield Renewable is likely to pick up a lot of the slack, as most companies have already moved away from fossil fuels. Its dividend is quite stable and likely to expand, thanks to many contracts signed for decades down the road. BEP's dividend yield of 3.26% is high enough to put it in the debate of best high-yield dividends, but the true promise appears to lie in the company's development. Few renewable energy firms appear to be better positioned to power a greener world than BEP, and the company's dividend should only grow as it adds to the global power grid. Brookfield has a solid track record in which investors may put their trust for decades. Number 3. Whirlpool Corporation. Whirlpool requires no introduction, as its products are found in the vast majority of households across the United States. Despite this, the home appliance company leads the market in everything from refrigerators to water filters to laundry and dishwasher gadgets. Whirlpool has risen more than 33% in the last year as an industry leader, making its 2.64% dividend look more solid than ever. Whirlpool appears to be undervalued, aside from its high dividend yield. Whirlpool's PEG ratio of 1.29x is significantly lower than the household durables industry's typical PEG of 2.45x. A PE ratio of 9.95x supports the valuation, which is lower than the industry median of 13.02x. Taking everything into account, today's investors may be able to add a nice income stock to their portfolio at a terrific price. Number 2. Verizon Communications Inc. The Oracle of Omaha declared his trust in Verizon not long ago, at the end of 2020, and it's past time for other investors to do the same. Indeed, in the fourth quarter of last year, the calculating Warren Buffett increased his position in Verizon to $9.2 billion, making it Berkshire's sixth largest stock holding. For the same reason why Verizon entered our list of the finest high-yield dividend stocks, Buffett boosted his holdings. The leading provider of wireless communication services has a bright future thanks to the current 5G push. More significantly, the company's steady inflow of new subscriptions is more than enough to keep the company's already outstanding 4.52% dividend yield going. If that wasn't enough, classic value metrics show that this dividend stock is a steal with plenty more upside potential. Number 1. Walker & Dunlop, Inc. Walker & Dunlop is a financial services company that makes, sells, and services a variety of loans. Walker & Dunlop has built a reputation for specialized in multifamily and other commercial real estate finance products and services in particular. The company's clients are predominantly real estate owners and developers in the United States. According to the Mortgage Bankers Association, Walker & Dunlop is now the top multifamily lender in the United States. Walker & Dunlop, as the leading multifamily lender, is likely to gain from a surge in mortgage refinancing in the coming years. Walker & Dunlop will be able to benefit from a higher-yielding environment when loans mature and consumers refinance. Walker & Dunlop appears to be more than capable of not just sustaining but also boosting its existing 2.04% dividend yield as a result of an oncoming wave of maturities. Walker & Dunlop's 12.72x price-to-earnings ratio appears to be in line with the overall mortgage finance market, in addition to being a high-yield dividend stock. This company's fair valuation makes it look like a bargain with plenty of potential to develop in a market where everything is expensive. What do you think about our video? Let us know in the comment box below. Please like this video and subscribe to this channel for our future updates. Thank you.